Hello learners, today we'll continue with a series of our lectures in financial management. We've been considering the topic in cost of capital, the cost of capital. And in our last lesson, we looked at an illustration in which we were calculating the weighted average cost of capital. And we say that weighted average cost of capital is an average of the various categories that will exist or be found in the cost of in the capital structure. So the different components of cost of capital we determine the average, and we gave the procedure for calculating the weighted average cost of capital. And before that, we had identified the formula for weighted average cost of capital, and we say that this cost is an aggregate of the cost of capital plus V. This is the, so we considered the formula, and the first element, as you can see here, component, is the cost of equity. Then we add the cost of preference shares, P over V, plus the cost of debt, D over V. So with this formula, you are able to determine the weighted average cost of capital, where KE is the cost of equity, KP cost of preference shares, KD cost of debt. And E, P, and D is the market value for equity, market value for preference shares, and market value for debt. And V is the total market value of the various components in the capital structure. So with this formula, we illustrated, we did an illustration which enabled us to apply this formula. I remember we say that in computing the weighted average cost of capital, there are 3 steps. Step number 1, we computed or calculated, is to calculate, first step, need to calculate the specific cost, the cost of, we determine the cost of, we calculated, the first step is to, in calculating the weighted average cost of capital, in calculating the weighted cost of capital, the first step is to calculate, the cost of specific sources of capital. Step number 2 is the calculation or determination of the market values of sources of capital. All right. Then number 3, we say that the last step is to multiply the cost of specific sources with the weights. Multiply the cost of specific sources with the weights, and the weights are based on the market values of the specific sources of capital. So there are 3 stages. Today we will be looking at another illustration. Illustration number 2. Illustration number 2, and I read it. The following is the capital structure of Zaituni Limited as at 31st December 2016. Ordinary share capital 10% par value 400 million. Retained earnings 200 million. 10% preference share capital 20% par value 100 million. 12% debenture 100 shillings par value 200 million. Additional information. Corporation tax is 30%. Number 2. Preference shares were issued 10 years ago and are still selling at par value. Number 3, the debenture has a 10-year maturity period. It is currently selling at 90 shillings in the market. Number 4, currently the firm has been paying dividend per share of 5 shillings. The dividend per share is expected to grow at 5% per annum in future. The current market price is 40 shillings. Required. A, determine the weighted average cost of capital of the firm. So that is the question. Determine the weighted average cost of capital of the firm. So the first thing to do is, as I said last time, you need to master the formula. The formula for weighted average cost of capital is equal to cost of capital times the weight, cost of equity times the weight, cost of debt times the weight. So you can now proceed with step number 1. Step 1 is to calculate the cost of specific sources of capital. Now in this question, there are various sources, specific sources. The first one is ordinary share capital. The next is the cost of preference share capital. Then we have cost of debentures. We have the cost of debentures. So we need to determine the cost of specific sources of capital. One specific source is equity. So what is the cost of equity? Cost of equity, KE, is equal to, remember we say that there are 2 categories of firms: zero growth firm and constant growth firm. If it is a zero growth firm, then we will use a zero growth firm model. If it is a constant firm, then we will apply the constant growth rate dividend model to determine the cost of equity. In this case, looking at this question, note number 4, we are informed that currently the firm has been paying dividend per share of 5 shillings. The dividend is expected to grow at 5% per annum in future. So in this case, the question is straightforward. We will use the constant growth rate dividend model to determine the cost of equity. And in this model, cost of equity is equal to the dividend, expected dividend, denoted as D1, over the market price, PO, right, plus G. So with this, we apply 100, this will give us the cost of equity, where D1 is the expected dividend. So going back to the question, the question note number 4, we are informed that the firm has been paying dividend per share of 5 shillings. 5 shillings has been paying. So that is the current dividend per share. So the current dividend per share, current DPS, which is denoted as D naught, is equal to 5 shillings. But remember here, the formula is D1, which is the expected dividend per share. D1 is supposed to be the expected dividend per share, not the current dividend per share. But with the information that we have, we can determine D1. And as I informed you earlier, D1 is equal to D naught into 1 plus G. To 1 plus G. All right? That is how to determine the expected dividend. So the expected dividend per share is equal to the current dividend per share, all right? Current dividend per share times 1 plus G. Just repeated it, which is the same as D1 is equal to D naught into 1 plus G. So our D naught is 5 shillings into 1 plus G. The growth rate is 0.5. 0 is 5%, which is equivalent to 0.05. Converting 5% into decimal, we have 0.05. So the expected dividend should be 5 into 1.05, 5.25. 5.25 shillings. 5 shillings and 25 cents. So that is the expected dividend. Now we can proceed to determine our KE. So therefore, KE, substituting these variables in the formula, will be equal to the expected dividend of 5.25 over the market value of this share, which is 40 shillings, plus G, which is 0.05 times 100. So this will be equal to, calculator, 5.25 divide 40 is equal to 0.13125 plus 0.05 times 100. So our cost of equity here is 18.13%. So that is how you determine the cost of equity. Cost of equity is 18.13. Then the second, this is the first component or category. The second category is the cost of preference share capital. Cost of preference share capital, and this is abbreviated as KP, and KP is equal to DP over PO times 100, where DP is the dividend per share. Dividend per share. In additional information number 2, preference shares were issued 10 years ago and are still selling at par value. So the par value is 20 shillings. The par value is 20 shillings. And remember, the coupon rate or the rate, the dividend rate here is from the question 10%. So DP or dividend per share will be the 10% times the par value. The par value times the par value of 20 shillings. Par value of 20 shillings. That will give us the dividend per share. The dividend per share for this preference share capital is 10%, and for you to arrive at the dividend per share, you multiply that with the par value, which is given the question. And remember, we've been informed that since the in note number 2, we are told that preference shares were issued 10 years ago and are still selling at par value, which means the market value, the market per share is equal to the par value. The market price per share is equal to par value. It was bought 10 years ago at 20 shillings and it still remains at 20 shillings. Still remains at 20 shillings. So this will be the cost of preference share capital. So we have 2%. 10% of 20 is 2%. So we have it 2 divide 20 times 100. So the cost of equity is 10%. 10%. Cost of equity, cost of preference share is 10%. So the other component here is the cost of debt, cost of debentures. And in note number 3, we have the information in regard to the debentures. We are told that debenture has a 10-year maturity period. It is currently selling at 90 shillings in the market. So we know the formula for redeemable debentures. So before you go to the formula, you need first of all to check if the debenture is redeemable or irredeemable, because the formula for determination of the cost of redeemable debentures is different from the one for irredeemable debentures. In this question, these debentures are redeemable after 10 years. So the third, this is number 2. Number 3, we are talking about the cost of redeemable debentures. Redeemable debentures, KD. And we saw in our last lesson that KD is equal to the interest plus 1 over n into m minus VD over 1/2 m plus VD. So this is the cost of debt before tax. After tax, we apply 1 minus T, where T is the corporation tax. So from this question, what is the interest? The interest per debenture. Then N is the number of years to maturity. M is the par value of the debenture. VD is the market value of the debenture. So from the question, what is the interest? The interest is given at 12%, which means we can apply the 12% on the par value of 100 shillings per debenture. So 12%. So the interest here, interest is equal to 12% times the par value of 100 shillings. That will give us the interest. N is equal to the number of years to maturity, and we have it at 10 years. M is the par value, and the par value for this debenture is 100 shillings. VD is the market value. The market value, we are told that it is currently selling at 90 shillings in the market. The selling at 90 shillings in the market. So we have all the variables, and the T is 30%. So with these variables, we can now apply the formula. KD is equal to the interest. The interest is 12% of 100 shillings. That is 12% of 100 shillings. That will give us the interest. The interest is 12% times 100, and it's 12 shillings. So the interest here is 12 shillings. So the interest rate is 12. So you apply the 12 on the par value, which is 100 shillings, the par value. So we have it at 12 plus 1 over n. Our n is the number of years, which is 10 years, into M is the par value 100 shillings, minus the market value 90 shillings, close the bracket, divide that by a half into M 100 minus N minus 100 minus 90. Then of course here we apply 1 minus T, which is equivalent to 0.7. So this remains the work of a calculator. We apply the calculator there. We calculate so that so the numerator there, 10%, we're talking about 1 over 10. That is 100 minus 90 times 0.1. So this is 1. 10 times that is 1 plus 12 is equal to 13. 13 divide by 13. We divide 13 is the cost of debt. The cost of debt. So that is the first step. The first step is to calculate the cost of specific sources of capital, and that is what we have done. That is what we have done. Specific, we've determined the cost of specific sources of capital. And we have seen that KE is KE 18.13%, KP, cost of preference shares, is equal to 10%. It's 10%, and KD is equal to 9.58%. 9.58%. That is the first step. Then the second step is to calculate the calculation of the market values of the sources of capital. Market values of the sources of capital. The market values of the sources of capital. So that is the second stage. And we can do that in a table. Can come up with a table to determine the market values. And the market values will be determined depending on the information given in the question. If you are given the market values per share, then what you need to do is to determine the number of shares, then apply the number of shares. You multiply the number of shares. You multiply the number of shares by the market price per share. The market price per share. For example, in this question, we've been given the market values of the specific sources. So the market values for the specific sources will be equal to the market price per share times the number of ordinary shares. Times the number of ordinary shares. So I prefer having this in a table so that we have a column for the source of capital, then another column for the market values, and here we determine the market values by applying market price per share times number of shares. That's what we'll do. So we start with equity. Equity is the first source. So what is the market price? The market price for ordinary share capital is 40 shillings. So we have 40 shillings times the number of shares. That will be equal to 400,000 divided by the par value. The par value of equity is 10 shillings. So that will be the market value. Still at 100,000. There is no change. So we are not going to make any calculation because since 10 years ago, the par value has not increased. So the market value is the same as the par value. Then we have lastly debentures. Debentures, the market price for debentures is at 90. We multiply with that with the number of debentures. How do we determine number of debentures? We divide the par value for debentures by the market, we divide the par value of the debentures by the debenture amount per debenture. We divide the par value for debenture, total value for debenture, by the amount for debenture. So the par value per debenture, we have the we are given 200,000 shillings. 200,000 shillings. We are going to divide the value for debenture, which is 200,000 shillings, total value for debentures, divide by the value per debenture. The value market, the par value per debenture is 100,000. I mean 100 shillings. This is 100 shillings. So that will give us the market value per the market value for the specific sources. And this you need to remember always. Where the market values are not given, this is the formula. Take the market price per share or per debenture, multiply with the number of shares. So we can now calculate the market values. Starting with equity, number of shares will be 400,000 divided by par value of 10. So here we have 40,000 shares times the market price per share of 40 shillings times 40. This is equal to 1.6 million. Then for debentures, the number of debentures, take the 200,000, divide the par value per debenture, 100. I have here 2,000 debentures. Multiply the number of debentures by the market price per debenture of 90 will be equal to 180,000. 180,000. So we get the total market value of the sources of capital, which is equal to 1.6 million plus 100 plus 180. 180. 180. This is 1,880,000. So this will be the total market value. The total market value. Now with this total market value, we can now determine the weights. We can determine the weights. And how do you determine the weights? Simply take the market value for specific source, divide with the total market value. For instance, the equity weight will be equal to 1.6 million divide 1,880. 1,880. The weight here is 0.85. 0.85. For preference shares, 100,000 divide 1880, 0.5. 0. This is 0.05. 0.05. Then lastly, 180 divide 1880. I get here 0. This is 0. Rounding off, this will be 0.1. 0.1. This is 0.1. 0.10. 0.10. So these are the weights. the weights. Then of course we need another column for the after-tax cost of the specific sources which we had obtained in our first step. This we had calculated in our first step, KE 18.13, 18.13%, and of course we had our KP of 10%, 10%, then lastly KD 9.58%, 9.58%. So these are the after-tax costs, the after-tax costs. So that is very important, because remember, we are determining weighted average cost of capital in stages. The first stage is to calculate the cost of specific sources, which we did. Number 2, calculation of the market values, which you have determined. Then number 3, multiply the cost of specific source with the weights. Okay, so determining the weighted average cost of capital, here we have the weighted average cost of capital. We are saying multiply the cost times the weight, then we will aggregate. So we have the cost times the weight. So the cost times the weight, you multiply the weight with the cost. So 0.85 times 18.13. So I have here 15.41. Next, 0.05 times 10. I have here 0.5. Then lastly, 0.1 times 9.58. This will be equal to 0. This is 0.95 will be equivalent to 1.0. So we can now aggregate to arrive at our WACC. Aggregate, get the total. 15.41 plus 0.5 plus 1. So the weighted average cost is 16.91. 16.91. This is the weighted average cost of capital for this firm. So this is how you determine the weighted average cost of capital. Weighted average cost of capital. That is the column for equity. This column for the row for preference share capital, and the row for debentures. Row for debentures. So that is how to determine the weighted average cost of capital. So the weighted cost of capital is 16.91, and I've just used a table, but it's still the same concept. Remember, this is the formula. KE E over V plus. All right. So this KE E over V is what we have determined here, because we have multiplied the weight by the cost, which is the same thing here. The weight by the cost plus weight times cost plus weight times cost. So plus plus plus, we have added 15.41 plus 0.5 plus 1.0 to arrive at 16.91. So that is how to calculate the weighted average cost of capital. There are how many stages? 3 stages. 3 steps. Step number 1, calculate cost of specific sources of capital. Step number 2, calculate the market values of sources of capital. Then lastly, multiply the cost of specific source with the weights. Just 2 things. You just need the weight and cost of capital. The weight and cost of capital. The weight and cost of capital. So that is now the end of that subtopic on weighted average cost of capital. We have demonstrated, we have illustrated 2 illustrations, step by step, step by step. So as a good student, I send you to go revise, practice. This is a common area in examination. If you are to check our revision partner, under the cost of capital, we have listed the questions as they have been examined by the examiner. So go to that section on cost of capital, attempt all the questions, then you mark, because the answers are at the back of the book. Make sure you practice all the questions and mark. Where you have challenges, we have also developed videos under our block revision series. All the questions in the revision partner, that is the past paper questions, have been solved in a topical manner in our block revision series. But before you go to that series, I advise you to make sure that you attempt the questions on your own, so that where you have challenges, then we'll be able to help you out, solve the areas that are most challenging. Thank you very much. We proceed with our next lesson next time.